Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, the 21st of August. The technology sell-off extended into a second session yesterday, but selling pressure seems to be cooling down despite a more hawkish than expected language in the FOMC minutes released yesterday that showed that most Fed officials there were actually more concerned about inflation risks than they were about jobs in the last monetary policy meeting. But wait, because that was before the latest drama around the latest jobs report. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So yesterday's FOMC minutes further dampened investor mood and accelerated the equity sell-off, which was again led by significant drops across the big technology space. The minutes there actually stated that Fed officials were worried about both weakening jobs data in the US and inflation risk due to tariffs, but that a majority of participants judged the upside risk to inflation as the greater of these two risks. So that means that Fed officials would be more inclined today to take care of inflation first by keeping the monetary policy and the rates tight enough than cutting the interest rates to help boost the jobs space. Yet, there is one thing that still makes the minutes look somehow less hawkish than they first sounded, and it is that this meeting was held days before the release of that problematic July jobs report from the US and the big downside revisions to it that actually led to the firing of the BLS chief, and that really spooked investors and fueled the September rate cut expectations from the Fed. So, what the Fed President Jerome Powell will say tomorrow at his Jackson Hole speech could be somewhere in between these two, probably showing a bit more worry about the weakening jobs market in the US, but not forgetting that inflation is still a risk that must be addressed carefully. So, in my opinion, the Federal Reserve will probably announce that 25 basis point rate cut next month, but stop short of cutting the interest rates by more than that. So a 50 basis point cut is clearly off the table to me. So the US 2-year yield was under pressure yesterday into the Fed minutes, but rebounded on more hawkish stance from most of the committee members, while the President Donald Trump, who doesn't really agree with the majority of the people sitting at the Federal Reserve's decision committee, called for Lisa Cook there to quit this time, and the thing was over allegations of mortgage fraud. It's surprising because she has a dovish approach. She's not against cutting the interest rates, but she prefers a data-dependent and a gradual approach to the monetary policy decisions. Maybe it's just not even personal. But whatever it is, the US 2 to 30-year yield spread is widening on worries that today's rate cuts would boost tomorrow's inflation in the US, and the piling US debt obviously will be more expensive to finance if that's the case, if the yields or the rates will be higher tomorrow due to higher inflation. Now, one bright spot, though, is that Trump's tariffs are apparently bringing cash that could soften the fiscal burden, according to S&P Global Ratings, but they also warned that the trade war could lead to a new world order that would be dominated by China. Anyway, the pressure on the long end of the bond yield curve doesn't really help soothing investors' worries these days, as the less risky bond investments, they are now paying a higher return to investors, hence they become more attractive, more appealing for investors. So the Japanese 30-year yield is also testing the highest levels this year, and the highest levels this year is also the highest levels that we have not seen since more than 2 decades in Japan, and that could also trigger Japanese reverse carry trades. So that's a trade where investors are closing their positions that are funded by low yielding Japanese yen and return to better yielding Japanese assets, and that could eventually cause some global stress as well. So if that's the case, we could see the pressure on global risk assets mount in addition to the trade risk and the Fed worries. Now, looking at the US markets, the S&P 500 remained under the pressure of further exits from the big technology names yesterday, though we saw a minor rebound in the final stretch of the session, while futures are hinting at a more stable start this morning at today's session. Futures in Taiwan Stock Exchange, for example, are better a bit today. TSMC is up by 1.30% at the time I'm talking here, hinting that the selling in US technology stocks could also cool down today. Indeed, Nvidia slipped below the $170 per share level yesterday before the buyers rushed in, and SPDR's technology ETF rebounded from its 50-day moving average level. Whether the sell-off across the technology space, hence across major indices, will accelerate and lead to some sector rotation is yet to be seen, because technology earnings have been solid in the second quarter of this year, and Nvidia hasn't said its last word just yet, but AI appetite is already fully baked in the market prices, and the Fed expectations have probably gone a bit too far to allow some readjustment toward the hawkish end when long-term government bond yields are also pushing higher these days. So the risks are there, but we don't yet know if this is the beginning of a further sell-off or it is just a blip on the way. So today investors will be watching a series of PMI data across the globe and think and rethink about their policy expectations and their positioning. So far, the Japanese manufacturing data came in past the market expectations, but the data remained in the contraction zone still due to lower foreign demand, and that's because of the tariff pressure. That means that the Bank of Japan will certainly not be rushing to further rate hikes before making sure that the Japanese economy is on a stable path amid the tariff concerns. In India, however, the manufacturing PMI printed its strongest growth since 2008. There, in India, growth in export orders actually remained quite unchanged, but the domestic demand apparently boosted the numbers. The Nifty 50 index in India extended gains above its 50-day moving average this morning, defying the souring risk appetite elsewhere in the world. Now, numbers will likely point at steady contraction in the European manufacturing sector as well when they are released today, while slight expansion in services is expected. The European Central Bank Chief Christine Lagarde warned yesterday that the euro area could eventually see a slower growth this quarter due to the tariff pressure. So she also added that the tariffs, as they were announced, so at 15% for the European goods toward the US, were a little higher than what they assumed in their June monetary policy meeting, but they were still much lower than their worst case scenario. So the euro dollar is hanging around this 50-day moving average level, waiting for a fresh direction from tomorrow's Jackson Hole meeting, where Mr. Jerome Powell will be giving a speech and hence will probably be giving a fresh direction to the US dollar, hence to the US dollar peers. Across the channel, cable extended losses at yesterday's trading session, and that despite a higher than expected CPI print from the United Kingdom, hinting that the services inflation spiked to around 5%, while the data initially boosted the hawkish Bank of England expectations and weighed on November cut bets. Many still came to the conclusion that the data won't take the November rate cut off the table for the Bank of England, as April's tax and minimum wage hikes in the UK will pressure the economy enough to give reason to the Bank of England to keep cutting the interest rates there, just to make sure. Meanwhile, talks over what will happen in Ukraine continue in the background, with Russia reportedly willing to be part of the Ukraine security talks with its Western allies. That's not necessarily excellent news, mind you. Any lack of progress toward durable peace in Ukraine could bring the oil bulls back to the market. The US crude found ground near the $62 per barrel level earlier this month and is pushing higher this morning. The summer decline opens the door for a medium-term rebound if peace hopes in Ukraine were to fade. That could eventually send the price of a barrel of US crude above the $65 per barrel yet again. So that's a space to be watched in the coming days. So this is all for today. I'm İpek Özkardeşkaya and thank you for joining me and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions and your questions below as usual. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.